Welcome everyone to the Origin Investing Guru series. I'm your host today, Michael Episcope. I am co-CEO of Origin Investments. And today we have an amazing guest with us, Jim Dahle, the white coat investor. And you might be wondering how a conversation with somebody like Jim fits into our real estate content strategy and the ecosystem of our content. And the goal of this series is a little bit different. It's really to add value to the lives of our investors well beyond just real estate, because real estate is one component of your portfolio and your investment strategy. And we want to help people make smarter decisions around their entire portfolio. And I can't think of a better guest to do this than Jim Dahle. Now, this will be a 1-hour webinar today. It's going to be a 45 minutes of conversation between Jim and me. And I want to thank you for those who submitted questions in advance. Appreciate that. That will help frame our conversation. And if you have questions during the webinar, I think by now everybody is a Zoom expert. You can go to the Q&A box. We will try to get to those at the last 15 minutes. Submit your questions. We have more than 1,000 people attending this webinar today, and it's really a testament to all of the excitement surrounding Jim. Now, I've known Jim personally for a few years, and I'm incredibly happy about his success, and we'll talk about his success, the success of the white coat investor. And the reason is that Jim is rooting out the unethical players in the business. That is his mission. And he is elevating the good ones. And the more success he has in the business, rooting out these bad actors, the better off everyone will be. And nobody wields the power of the pen better than Jim. So without further ado, let me introduce our guest today. Jim is a doctor. He is a blogger. He is a podcaster. He is an operator of one of the largest financial literacy events in the United States. He is an author of 2 financial books. He is an outdoor enthusiast. He loves canyoneering, he's playing hockey, skiing, and he's a pretty good snowboarder too. He is a father. He is a husband, and someone in many ways no different than you or I. He has done a lot of things right in his life and gotten some things wrong too. And it's those lessons he writes about with such passion and authenticity that helps so many people avoid those same mistakes. His blogs are read by hundreds of thousands of healthcare professionals throughout the country and the world, and he has been described as a genius and is known as the white coat investor. Jim, welcome to the Investing Guru series.
Thank you very much. Even being called a guru, I mean, you're laying it on pretty thick here.
Wow. I would definitely say that you are a guru. I mean, I'm a subscriber to your blog. I read them on a daily basis. I think what you write is so simple and eloquent, and you, like so many other, maybe people in your position, I mean, you operate not only in the real estate space, but across the entire spectrum, right? In insurance, you understand that. You understand the power of asset allocation and just throughout the financial area itself. So thank you for coming on the show today. But I think guru and genius, those are two labels that are appropriate for you. And I know your humility is appreciated. So let me first, Jim is a doctor, and I want to acknowledge all the healthcare workers out there and the work you do, the frontline work, especially with the pandemic that we're in today. So, it's appreciated by everybody. So thank you again, Jim, for being here.
Thank you. It's my pleasure.
Now, the first tough question, how bummed are you that the snowboard season was cut short?
It was really terrible, actually. If I'd known you were such a good snowboarder, I would have worn skis the day we went together, though.
Yeah,
I'm a much better skier than I am a snowboarder.
You were
but
great.
certainly, having come home from our conference in Las Vegas and finding that basically the ski season was over, I was kind of disappointed because I'd spent most of it getting ready for that conference and was planning to really hit it hard at the end of the season, which basically just disappeared.
And that conference was in early March. We were just talking about that, how you were basically the last conference to be had at the, right before the pandemic was, announced as a pandemic itself.
Yeah, basically it was the strip was completely packed while we were there, and the day after the conference ended, the CDC recommended against gatherings of 250 plus people, and
Yeah.
so it
Good
really did
timing on
feel
your
like
part.
the
Right.
last conference in town.
All right.
Whether it was a little too late or the last conference, I suppose, is in the mind of in the eye of the beholder.
Yeah, well, I'm sure you're going to have more conferences in the future that will be even bigger than that one. So, let me jump in here to a question for our audience, because this has been dubbed "How to Turn High Net Worth into High Income," and that's what we're going to focus on today. Because you historically have focused on the doctor community, and I think there's so many parallels, and we'll talk about that as well. You have been referred to as a financial genius, and yet you don't have a CFP, you don't have your KIA designation, you don't have a CPA, you're not a wealth manager. So what is it about your message that resonates with so many people, and why do they heed your advice over the experts and other professionals out there?
I guess you'd have to ask them, but I suspect the reason why is because I bridged two fields of knowledge. I basically bridged people that were in medicine and these other high income professions and the finance world. And so I could talk to people about financial stuff in their language as one of them. And so I think a little bit of that trust was there, and the ability to put it into terms that they understood was there. And I suspect that is why I've grown such a large following. The other thing is I always put that number one, their trust in me, and tried to be overly transparent in my conflicts of interest, how I made money online, et cetera. And so I think there was a great deal of trust there. And that's really a big problem among doctors and others. They are very skeptical of the financial services industry, and it's really hard to know who you can trust. And so I think that's probably why the following grew so big. The other reason is it was just content that no one was putting out there. It's not that it was terribly complicated, but no one had really synthesized it all and put it in one place for the high income professional. And so it was just, it was a niche that hadn't been filled yet.
Yeah, and I would add, I mean, your independence is unique as well. I mean, you're giving away all this information for free. You don't get paid for financial advice, correct?
That's correct. I'm definitely not a licensed financial advisor. So
right, when you're giving
I wouldn't say I don't
free,
make any money, though. I sell a lot of ads on my website and my
right.
podcast and so forth.
Yeah, and we'll talk about that at
Money.
the end. So, this is taken right from your website. And what I really want to get into and start with your background and your story. And this is a quote: "Although I've always been interested in personal finance and investing, I really started diving into the field midway through residency when I finally got sick of financial professionals ripping me off." Tell us about that.
At that point, I think I had been ripped off by just about every type of financial professional there was. That includes a recruiter, a mortgage lender twice, a realtor, insurance agent who happened to be a very good friend, and a financial advisor. And it was the final straw was probably the financial advisor, and it was a mutual fund salesman masquerading as a financial advisor, who was putting me into products, not really giving advice. And then one day on a road trip in residency, I had my 2 weeks vacation or whatever it was. I picked up a book, Mutual Funds for Dummies. And I read through it and I said, oh, I think I have these no-load mutual funds. And I got home, I looked up my mutual funds, and I realized that I was paying this guy both fees and commissions. And that made me mad enough to just start visiting the used bookstore and picking up a bunch of financial books and reading them.
Yeah. And do you think, Jim, is that the common, like you mentioned, fees and commissions? So in the financial world, is that what binds sort of the unethical with the more ethical and the way they charge?
Not necessarily. I think it's more of a transparency thing. I do think it's hard to give good, unbiased advice while you're making commissions. I think that's harder. For example, I have a salesman that sells ads for my website. She's paid on commission, right? If you go there and ask her to tell you about the different kinds of ads we sell, she's an expert, right? But if you go there asking, should I advertise here? Don't expect an unbiased response. And it's the same thing if you go to a commissioned insurance agent or a commissioned mutual fund salesman. You don't go to a barber and ask if you need a haircut. And it's the same problem. If you need advice, pay for advice. If you need products, then it's okay to pay somebody with a commission for those products. Yeah, the problem is people that sell products pretend they're giving advice.
Yeah.
and it's really not unbiased at all.
Yeah, yeah, and I think in our business, there's nothing, we've railed against the non-traded private REITs for their commission-based structures. And I think you have to question anytime you have these hidden fees and structures, a lot of times that's just the tip of the iceberg, and it's indicative of how people do business. And if they're hiding the way they get paid and their fees, and you have to question their entire practice. And we saw that it's getting better in our industry and the way they've constructed fees, but it used to be that your load was 17, 18, even 19% through a non-traded private REIT. And we're starting to see that get better with the transparency in the market. So Jim, how long was it before this happened and you actually put pen to paper, right? So you got ripped off, you were pissed off, you were a resident, you were a doctor, like so many other thousands of people, and you were mad and decided to then write about it.
Well, it was a surprisingly gradual process. As I read books, spent time online on blogs and forums, I gradually went from learning from others to teaching others and realizing that there was nobody out there teaching this to doctors. So long before I started the White Coat Investor blog in 2011, I was on internet forums doing the same thing. I was on the Student Doctor Network. I was on bogleheads.org. I was on Sermo, which is a physician kind of forum. And I was kind of doing the same thing that I started doing on the blog. And I got sick of typing the same thing over and over again into the internet. And I said, well, if I put this as a blog post, I can just put a link to that post in response to the questions. And so initially, it was going to be a big time saver for me to help all these people without doing it. The other thing that got me really excited to start a blog in 2011, for some reason that year, I got really excited about passive income. And I said, well, I can make a blog and it'll be passive income. I just had no idea just how active that income was going to be and how long it was going to be before there was actually going to be any income. But that was kind of, those two things were what caused me to start the White Coat Investor blog in May of 2011.
Yeah, and I would say you're anything but passive. And anybody who subscribes to the White Coat Investor blog, and I would highly recommend they do, Jim is one of the most prolific writers. And you would think that he has a team of 10 editors behind him, but it's him. He's the one doing this. He's writing all these articles. And every day you're getting something in your inbox, either that's been repurposed from something he previously wrote about, or brand new that he is inspired by maybe something in his life. And maybe you can talk about that, Jim, just slightly, because I'm curious, where do you find these ideas that come up that inspire you to actually write something? And I'll give you an example. Today, I was so intrigued. You had a blog that came out that seemed a little left of center, but 9 tips on hiring a contractor for your house, right?
That's right. So this was actually a guest post. The way the content on the blog works is I write something original on Monday and Friday, or I publish something original on Monday and Friday. Sometimes it's written weeks or even months before, but my original stuff's Monday and Friday. Tuesday is something that's been published in the past that we update and republish. Thursday is podcast notes from the weekly podcast. Wednesday is a guest post. And that's what this one this morning was a guest post from actually my general contractor that just finished renovating my house. And so I said, you should write a post for my blog. And so they did. And
Wow.
I had a good experience, and I said, well, these guys can probably teach something to people about contractors.
That's
so
good,
that's
'cause
what
so
this
many
morning
people
was.
have bad experiences with contractor. And certainly, if you think about that in the realm of money, you can save money on the contractor and you don't make mistakes there. That's more money that can go into your investment portfolio. So I found that, quite a refreshing article and certainly something timely for me. So did you ever think that, when you kind of go through the arc of your career here, right? You became a doctor, a blogger, you talked about passive income. What was the vision, back then of what the WCI, and I guess in the beginning, I'm also curious, you spent all of this time educating others. And did you ever think about that it was going to turn into money? And why did you spend all your time doing this?
Yeah, from the beginning, it was for profit. I mean, I splashed ads up on the site the first week. It was always a for-profit enterprise, and just wasn't very good at it.
Yeah.
Number one. Number two, the audience isn't very big when you start, right? You have to
Right.
keep at it, and you have to promote yourself if you want to help people.
Yeah.
And so that was a little bit of a change from, the typical doctor mindset where we don't advertise at all to promoting yourself, or you're never going to help anybody. And
Well,
so I
clearly you
think
struck a
that was
nerve.
part of it.
You've got quite a big following today. I want to read another quote here because I think it, just leads into this next part. But if I didn't acquire at least the basic understanding of personal finance and investing, that I would continue to be the target of unethical financial professionals for the rest of my life and perhaps never reach my financial goals. We talked a little bit about what that looks like, these unethical financial professionals, clearly. But I suppose, aren't these people fiduciaries? Or is that a term that maybe people don't understand?
Well, the best way to understand fiduciary, at least for a doctor, is it's basically Hippocratic. It's someone who has said, I'm going to put your interest in front of my own. And so the problem is the vast majority of the financial services industry is not a fiduciary, including some who call themselves fiduciaries. It's one thing to legally be a fiduciary. It's an entirely separate thing to actually act as a fiduciary. And, there's this idea that years and decades ago, managing people's money was, it was a highly regarded profession. You were taking grandma's money and you were making it last, and you were really a trusted family confidant. And somewhere in that time period, I think it drew in maybe not so scrupulous people that didn't view it as a profession like law or medicine or accounting or whatever, and that it became more of a sales kind of profession.
Yeah.
And I think that was part of the issue. But even if you look at all the people that call themselves financial advisors, I don't think it's more than 5% of them that actually have a legal fiduciary duty to you.
Yeah, a legal fiduciary, and that's the difference. And it is interesting. Somebody said this to me, not even that long ago, but I thought it was so eloquently put. And he said, look, if you want to ask your financial one thing, just say, are you a fiduciary? And they will respond in one of two ways. And if you're a fee for service only, right, you are a fiduciary. And they'll say, yes, I have your best interest at heart. I can look at the universe and I'm going to do, but if they're not, and they operate under the advisory rules and broker dealer and commission-based products or a hybrid, then they will spend several minutes explaining what that is and in doing this. And it was interesting because I actually empowered my wife here because she manages or she sits on a board that helps manage some money for an endowment. And she was asking me questions about this, and I looked at the portfolio and I said, look, just ask him that question. Are you fiduciary? And she said, and I did, and he squirmed in his seat for a few minutes. So it was very interesting, and she's very stoic, and she just sat back and listened and watched. But what I found interesting is even at the most sophisticated levels, you have to be careful because she asked me to look at the portfolio, and I said, look, I'm not really qualified to look at this portfolio. I'm not a financial manager, but I decided to anyway. And the thing that stuck out to me right away, looking in there, and this doesn't take a genius, is I'm like, what are these structured notes? And then I decided to dig in and look at this. And you think that one of these big money managers is going to have your best interest at heart, but these are commission-based products. And when you really dig in, and I guarantee I dug in more than this, advisor ever did, I went through and did the math and understood like the idea that these would never do any better than a corporate bond. In fact, they probably would have done a lot worse. And so, it's just interesting when you get the brochure and how great they look, but then you read the fine print and do the math and understand the expected return. So I think that, people really have to question, unfortunately with some of these commission-based products, the truth is on page 45. And that might be disclosed, but it doesn't mean that it's, you're going to understand it or be presented to it correctly. So we're in total agreement there. Jim, your audience tends to be doctors, professionals, right, in the healthcare area. And how do these, in the audience today, we certainly are going to have plenty of doctors, but other people who are high net worth and who want to, or high net income and want to get to high net worth. So what is the difference, I guess, when you're talking to a doctor group versus a non-doctor group?
Jonathan Clements refers to this as the most important financial task of your life, basically building a nest egg to live off of after you can no longer work. And that essentially is converting that high income into a high net worth. And it doesn't really matter where the high income comes from. It's certainly hard to build a high net worth without a high income. Can it be done? Sure, through very, very savvy investing, through an inheritance, through a very long time period, et cetera. But most of the time, the secret to really building wealth is to first get your income up and then carve a large chunk of it out and use that to build wealth. You know, this idea that you can decouple saving from investing, I think is insane. If you really look at it, these people that are trying to FIRE, you know, financially independent, retire early, they basically look at it as all about your savings rate. If you can get your savings rate up to 20, 30, 40, 50, 70% of your net income, you can be financially independent very quickly. And obviously, the more you save, the more you have with which to invest.
So why do you think, though, we see these people who, you know, even in doctor communities, who have made a really high net income their whole life, and yet they're nearing retirement. They're 60 years old and they're broke. They don't have any money. Why does this happen?
It happens for a few reasons. If you look at the data among doctors, about 25% of doctors in their 60s are not yet millionaires. That includes everything, their house, everything. 25% after 20 or 30 plus years of physician level paychecks. It's just an appalling statistic. So why? Well, there's a few reasons. One, some people just never save any money. They spend it all. You know, just like you can spend all your money when you're making $50,000 a year, you can spend it all when you're making $500,000 a year almost as easily. So that's reason number one. Reason number two is divorce. You know, you get divorced a couple of times, it makes it a lot harder to build wealth. It cuts your assets in half. It cuts your future income in half. It's really tough. And, you know, doctors have this reputation of having a high rate of divorce. Their rate of divorce is actually lower than the average population, but still high enough that that is the cause of a lot of them not building wealth. And then I think the third thing that's hard for high income folks, and this isn't necessarily just particular to doctors despite their reputation, is they are targeted by the industry. They are the whales. And people go after them in particular because of an assumed wealth, whether it's there or not. And they're particularly targeted by, you know, unscrupulous advisors who don't do what's right for them, and that retards their wealth building ability.
So what do you say to somebody who's, you know, a doctor who feels like, look, I feel like I've been doing things right my whole life. I've been making high net worth. I saved for a home. I did this, I did that, and yet I have no retirement. Is it too late?
I mean, it's never too late to make some changes, right? But compound interest being what it is, the longer you wait, the less of an effect you can have.
Right.
The other problem is you get accustomed to a lifestyle. That's why when I talk to groups of young doctors, medical students, residents, new attending physicians, I tell them the four most important words in my talk is live like a resident. If they can just not grow into that attending physician level income immediately, there's a lot of wealth there in the difference between an attending income and a resident lifestyle. And if they can capture that early on in their career, it really goes a long way.
Yeah,
but it's not like
I
you
love
can't
that.
cut back later. It's possible. People
Right.
do it, but it's hard. It's hard to cut your lifestyle back.
Yeah, you're right. It very much is. And I feel like, you know, when you're talking about doctors, that analogy really applies to a lot of high income earners from any field. You know, you see this in athletes, and certainly I grew up in the trading world, and, you know, there were people in their early 20s, mid 20s, late 20s making millions of dollars who, you know, unfortunately, you know, after you take into account, you know, taxes and, you know, they were buying assets, but assets that weren't income producing. They were actually liabilities, but they didn't view them as that. Second homes, things like that, and they found themselves in financial difficulty. So I love that concept of live like a resident, but really it's, you know, I think the story is live within your means, right? And always understand that money and income can run out, right? And this is a time that we're all realizing, especially during a pandemic, and how many people are in the line. And it's unfortunately, but so few Americans have savings to rely on. And I don't know, it's a very small percentage who have more than, you know, 2 weeks of savings. And then you go out to 6 months and you have 99% of the people, you know, who don't even have that much. And it's a really sad situation. And, you know, you have to do this early and often. But I do want to share a story. It was interesting because it was this live like a resident. And one of the first times I heard about this, I have two neighbors who are probably listening today, Kate and Eddie. They're both healthcare professionals. And I had mentioned to Kate one day, I said, hey, do you follow the White Coat Investors? She said, oh my God, my husband Eddie does, and this and that. And then I ran into Eddie walking dogs, and he said, Jim has changed our life. And he said, we are so much better than all of our peers because They have spent the last kind of 8 or 9 years doing nothing but paying off their loans. They have paid down $700,000 of loan. They have taken your advice of living like a resident and to the T, and done everything. And he was naming all of the financial freedoms that it was going to give him, right? The ability to work less, the ability to retire early, save more, travel more, just enjoy life. And I thought that was so great, because there's got to be stories that you hear about that every day, people thanking you. And it's just so interesting. Kate and Eddie have been able to do it, but I'm sure you also see people who hear this and it falls on deaf ears. But I want to say that, when you hear stories like that, it works. It's a very simple recipe, but it works.
Yeah, for sure. And the fun part about it is, the hardest part about personal finance for most Americans is getting their income up, right? If you look at the average American retires with a retirement account balance of something like 110,000, which obviously does not produce a lot of income.
Right.
And but with this group that I've focused on, doctors and other high income folks, they've already got that 90% done. All they've got to do is not screw it up, really. And so it's relatively simple advice that I give out, but when you apply it to a high income, it's very powerful. I would say my average reader or listener, I probably saved them 7 figures over the course of their life, and so it's no surprise that they're very grateful for that. But let's not kid ourselves that it's some sort of complex, financial advice I'm giving them. It's simple stuff that they could have gotten from their grandma or anywhere else. I just applied it to their situation and said, you know what? If you just save 20% of your income, you're going to be wealthy beyond your wildest dreams in, a few decades. So.
Yeah, and it doesn't sound that hard, 20% to forego, but it's that deferred gratification. Everything we looked at. If you can put off things today till tomorrow, you'll be much better off. Jim, I loved one of your articles and just the backdrop to it. It was "Money is Everything," and it caught my attention because I'm like, wow. That is a bold title. Money is everything. And so I read it. Talk to us, the audience, about that a little bit and what you mean by that.
Now, I have a confession to make. That wasn't my article. That was one of my White Coat Investor Network peers who wrote that article. But I totally agree with it. And the reason why is, think about what money can be traded for. Money is time. It's your time. It's your mental effort. It's, what you have deferred gratification on. Nearly everything you have can be exchanged for money. And in that respect, money is everything. Now, I'm not saying money is your relationship with your kids and things like that. But if you sit back and think about it, money and having control over it can provide you most of what you want out of your life. And so in that respect, I think money is everything. And we sometimes forget that it isn't just about the money. Money is also experiences, and it's safety, and it's healthcare, and it's all this other stuff that we value in our lives. And basically, when you try to value something in your life, you do so by ascribing a monetary value to it. And so rather than that being some sort of, evil point of view from money, you got to realize that this is just how we value things in our society, and realize that.
Yeah, I thought that topic was catchy. I did read the article. I guess I didn't catch the actual author of it, but I thought it was a great article. And I agree. And it's a controversial topic because we think about that, but there is a financial freedom. And I've always said, everybody knows that money doesn't buy happiness, but not having it causes a lot more problems. And you see, the number one thing that couples fight about is money, finances, things like that. So it's really important to get that in check early on and have a savings program and be on the same page as your spouse, because it creates, you can create great memories as a result, and do things and not have to worry about, take care of your basic needs, if you will.
For sure. They've surveyed retirees, and there's 2 things that make retirees happier. One is better health, which you would expect. The other is more wealth. The wealthier you are, the happier you are in retirement. And I think just facing that fact and realizing that how happy you're going to be depends on how well you save and invest now, I think is a pretty significant turning point for most investors.
Yeah. Well, let's talk about how to get there. We'll go into some tangible, but I love, you have, I think there's 6 or 7 steps. One of them is the financial plan that you start with. It's the number one thing. Talk to, me about the financial plan. Why is this step number one? Why is this so important?
I think it is so important to have a written financial plan for a few reasons. Number one, it forces you to set goals. A plan is worthless without step one, which is setting goals. And so many people run through life without any sort of a goal. But if you lay out a goal, an achievable goal, that's specific and can be measured and is, time limited, et cetera, these so-called SMART goals, if you will, then you're going to get to them. This has been shown time and time again. If you don't set goals, you don't achieve anything. And so that's point number one. But the plan itself is to get you to that goal. And it allows you to track your progress along the way. So I think it's really helpful to people to actually sit down and have a written financial plan. Written, not just some vague thing in your mind, because when you write it out, you realize where all the gaps are in your knowledge and in your plan. And so you got to go and fill in those gaps as you go along. I think it's a really useful exercise to write down your own financial plan from now until your financial goals. The other thing it does is when you get into a terrible economic situation, such as a pandemic, for instance, and the world is going crazy, the price of oil is negative, stocks have dropped 35%, a third of renters didn't pay rent last month, all of a sudden you've got a long-term perspective from that plan. You can go back and say, well, what did I say in my plan I was going to do when this sort of a situation hits? And I go back to my plan and it says, I'm not going to panic sell my stocks. In fact, I'm going to buy more and I'm going to rebalance my portfolio. And so it's a lot easier to do it when you made that commitment years ago to do it and actually wrote it down. And I think that's a very powerful wealth building tool. So I'm really big, and I harp on this over and over again to my readers and listeners. That's why I was so disappointed. I polled them a couple of months ago, and only a third of them have a written financial plan. So if you still don't have a written financial plan, get out there and get it.
So Jim, if somebody wanted to and go on your website, where can they find a financial plan? Do you have one? Because
I think there's 3 ways to acquire one. The hardest way, but the cheapest way, is the way I did it. Read a bunch of books, spend time on internet forums, read blogs, write it down yourself, and come up with it and write it down. I think that's the cheapest but most time consuming. The easiest but most expensive is to go hire a financial planner. This is what they do. They help you write a financial plan. And for a few $1,000s, they'll help put all the components together: insurance, investing, budgeting, estate planning, asset protection, everything, and help you come up with a written financial plan. But I found there was a big gap in the middle of people that really weren't quite competent to do it themselves, really didn't want to read a bunch of books, but yet didn't want to spend thousands on a financial advisor. So I tried to find something in the middle. And what that ended up being was an online course that I titled provocatively, Fire Your Financial Advisor. And I sold it for just under $500. My financial advisor advertisers hated the title. But really, the first module of it was how to interact with the financial advisor, how to find a good advisor, et cetera. So once they saw that, they weren't quite as upset. But it takes you step by step through a financial plan. It walks you through the insurance, what to do with your student loans, what to do about your housing, what to do about estate planning and investing and your retirement plans and all that stuff. And the goal was for you to come out of this 8-hour course with a written financial plan that you wrote yourself. You know where it came from. You know how to do the calculations. And that was my goal with that online course. But whatever you choose, whether it's doing it yourself or hiring an advisor or taking an online course, I think you got to do something to have that plan in place.
Yeah, it sounds, when I first started trading years ago, somebody gave me some great advice, which was the same thing. Plan your trade your plan. That's it. Go in with an idea of what you're going to do. You can tweak along the way, but if you don't go in there with some idea and some thesis, right, you're just going to be lost like everybody else. So great advice. Again, simple, not hard, but you've done the research, which is great, because when I hear, a few $1,000s to a financial advisor, no big deal. I do use a wealth manager on my side. But yeah, going through and reading, dozens of books and trying to get to the bottom, and you don't know what you don't know. So I think the happy medium is probably the courses that you've put together, or a financial advisor for a lot of people who have high net income. I thought it was funny looking at Fire Your Financial Advisor, because then when you go to your website, you do have financial advisors or wealth managers who are actually advertising, and then you have resources as well. But talk to, like, give a feel for that basic, what does it mean, fire your financial advisor, or how do people work with them better? And then when we go into that, I want to talk about your portfolio and get into some actual investing here.
Sure. Well, the truth is, I think about 80% of doctors want and need a financial advisor. So the best thing I can do for them is connect them with the good guys in the industry, someone that's going to charge them a fair price and give good advice. And so that's why I have a list of recommended financial advisors on there, because I'm continually asked by readers and listeners, can you send me to somebody? Can you send me to somebody? Can you send me to somebody? That's why I have it. It was originally free. I didn't charge anybody to be on the list. I just found some good people and put them on there. What I found, though, is I filled their practices so quickly that then they didn't even want to be on there. They're like, take me off the list. I got too many people knocking on my door. And so I ended up incorporating it into my advertising strategy. So they're all paid advertisers on that list now. But
well, you're
still I vet them so that they're good people giving good advice at a fair price.
Yeah, and you're somewhat the Pied Piper in this industry. So
yeah.
So Jim, let's talk about
keep in mind, most people still need that. So it's okay. But there is a minority that is competent and interested in doing this themselves. And so I try to give them the tools as well.
Yeah.
And I think it's important to just figure out which of those two people you are.
So Jim, let's talk about your portfolio, right? What is your current makeup? And then, if you want to talk about how it did during this pandemic, but also, maybe some of the struggles you had as we're watching the market eviscerate 5% a day, right? And people are doing the math and looking, and some of the changes that you've made as well.
Well, my portfolio, just to lay it out there, is 60% stocks, it's 20% bonds, it's 20% real estate. So those stocks are about 2/3 in the US and 1/3 overseas. I have a little bit of what we call a tilt in my portfolio towards small and value stocks. The historical data suggests that they will have better long-term returns than the overall market. That has not been the case the last 10 years, though. So it's really, when you tilt your portfolio to factors like this, you better have a long-term commitment to it.
Yeah.
In the real estate sector, in that 20%, I've got about 5% of it in publicly traded REITs. I just use the Vanguard REIT Index Fund for that. And then I've got another 10% in private equity investments, syndications, and funds such as yours. And then 5% in basically debt funds, private real estate debt funds. So that's kind of how my portfolio breaks down.
So how did your portfolio, number one, do during the pandemic? And then after this, right, are you thinking about any changes around it?
Well, my perspective is that everything's going to have its day in the sun. And so I take a very long-term perspective. My crystal ball always seems to be cloudy. I definitely did not see this coming 6 months ago. So I didn't somehow try to time the market and put everything in cash or short the market or put it in long treasuries or gold or whatever. My perspective has been keep a fixed asset allocation. So whatever did poorly the year before, I end up buying more of it. Whatever did well, I buy less or even sell some of it. And so I keep it rebalanced to those percentages throughout my life. And that's served me very well, funded adequately. That's certainly reaching my financial goals. And so when the pandemic came along, I did the same. Stocks dropped very rapidly, very hard. I think they bottomed out at about 35% down. So in March and April and May, when I was making my monthly contributions, they pretty much all went to stocks. And at this point, there's always
natural rebalancing, right?
It's just natural rebalancing. My bonds were doing fine, but stocks were down. So I ended up buying stocks.
Right.
Now there's always a little bit of a lag in real estate. You're not really sure where you stand. So I suspect the next couple of months, I'm going to be buying real estate with my new investments.
Right.
But
your stocks are back up.
The goal is to try to, keep things in balance. And I know there's going to be times when real estate does great. I know there's going to be times when stocks do great. I know there's going to be times when bonds do great.
Yeah.
And so I just try to own those assets when their day in the sun comes.
Well, congratulations for being so disciplined. And it doesn't sound like you're making any tactical portfolio allocation, no difference, across your portfolio right now.
No, just sticking with the plan.
Okay.
It worked in 2008. It worked in 2011. It worked in December of 2018. And as near as I can tell, it still works. So that's what
I'm curious about this. And you and I have never really discussed this, but you talked about stocks, bonds. You're in liquid public securities, right? But real estate, you actually choose to go into private investments. So I really have two questions. Number one, why private investments on the real estate side? And why not some of your maybe public equity exposure going into private investments as well, like private capital or venture or things like that? So maybe you can talk a little bit about that. But first, why private in the real estate side?
Well, I mean, I have public real estate as well. Basically that index fund owns pretty much all of the equity REITs in the US. But the reason I looked at private real estate was really twofold. The first was I liked getting depreciation. Depreciation is big. You can shelter a lot of income with depreciation, and it's a tax benefit that's basically not available to you through publicly traded REITs. You get the little bit of the 199A deduction these days from it, but it's not much. And so that's one big reason there. It's a little bit more tax efficient. The second reason, the other benefit of that compared to the public REITs is a little bit less correlation with the overall stock market. When the market sneezes, then you see that some of the public REITs sometimes get the flu. And that's the way it is right now. I think the overall stock market's down 15%, but public REITs are down 25%. And so that correlation is not,
right.
is not awesome for someone who's looking for diversification away from their equities. But the big reason I really liked about going to the private world is to get paid for illiquidity. I realized I don't need my entire portfolio to be liquid. It's okay to me to have some of it be illiquid if I'm being paid for that illiquidity.
Right.
And there should be opportunities to tie your money up for 5 or 10 years, where if that manager doesn't have to provide liquidity to me, he can take more risks and take a more long-term perspective. And so I wanted to capitalize on that with some of my portfolio. And that's why the private real estate investments. Now,
and you're outsourcing some of the decision making about buying, selling, things like that. And it's interesting because I almost view private investments, real estate or others, private equity, is there is an illiquidity premium that sometimes people should pay, because if you think about public, if your time horizon is 20 years, then you may, what good does liquidity do you, right? Except in the world of rebalancing. And I will say that as I look back on my own life, 08 and 09, I had opportunities to get out of the public security side during that, and that was a scary time. But the private investments that I had actually performed better because those managers didn't sell anything, right, on the private equity side, during that time. And I just couldn't even stomach the public side, right? I love real estate. I love that side. There seems to be more stability around it. Maybe it's because I know it, et cetera. But I would say that the fact that my money was locked up and illiquid actually helped me during that time. So I think it just depends on the individual, but you're right. And you should be paid for the illiquidity and actually alpha as well, because all things being equal, if you're going to have the same volatility and the same returns, just be in the public, but hopefully the private side smooths out the returns a little bit better.
Obviously that's the hope.
Yeah.
Sometimes the time horizon's so long, you don't really know until the investment goes full circle.
Exactly. Yes.
That's part of the difficulty of evaluating it is.
And I thought what you said about, real estate on the public side and even the Vanguard index is interesting, because we have a public security side to our organization now as well and follow it quite regularly. And even that 25%, I think most people think about real estate as 4 walls and a roof. And within real estate, you also have data centers and cell towers, and those are up for the year. Those are technology-related real estate investment trusts that fall into that bucket under the Vanguard index. And you also have, on the other side of the equation, you have retail and office, and those are dragging it down. So the index itself is down, but you have no different than what's happening in the broader S&P 500, where technology is bringing it up. The tech-related side of the real estate investment trust industry is bringing that up as well. So it's a uniquely fascinating industry, and to pull out the different parts within that index is something that we've been writing about to people, just about how to allocate their portfolio and tilt it towards certain directions, especially if you own private real estate and you already have multifamily. Sometimes the indexes will just expose you to more of that as well. But we love Vanguard just like you do for the low fees and costs, and its weighted index approach. So let me jump in here. We're coming up on 11:45. We're going to take some questions here. in a second. What is your one best piece of investment advice today that you can give somebody?
I think I'd have to say stay the course.
Mhm.
Whatever your plan is, stick with it. Because
Right.
if you look at the history of financial markets, you know that every 3 to 5 years, they're going to go absolutely bonkers. And that is the time when you make all your money. They say you make all your money in a bear market, you just don't realize it at the time. And April was a good example of that. Look how much the value of stocks, for instance, went up in April. It went up 25% or something. That's a lot of money. You have a portfolio is 25% larger than it was at the nadir of the Corona bear.
Yeah.
And so I think that's probably the most important thing. Whereas people who bailed out the low, waiting for times to be a little bit less crazy, they missed out on that. And so I think it's important, whatever your plan may be, to stay the course with your plan.
Yeah. So a couple more questions, Jim. What is the worst investment you've ever made, your best investment you ever made, and what did you learn from each?
Oh boy, the best investment I ever made. I would have to say my best investment over the years has just been buying everything, just big, fat, low cost index fund that buys all the stocks in the world, you know. And why that is so good is because I don't have to doubt the managers. I don't have to watch the managers. I don't even have to look at the performance of the fund. It's advertised on the news every night. You know exactly what it's done. And so I think that's probably what I would call my best investment. My favorite mutual fund has always been the Vanguard Total Stock Market Index Fund for that reason.
Yep. Set it and
Um,
forget it and go to sleep.
yeah. Worst investment, I'm in the middle of one that's wrapping up that is probably going to be a total loss on
Okay.
a syndication. And what I learned from it is diversification matters. What happened in this case is basically the sponsor of this syndication fraudulently went and got some more mortgages to back up other parts of his real estate empire. And the whole thing collapsed. The whole house of cards collapsed. And the primary lender is foreclosing, which is going to wipe out the equity investors.
Yeah.
And so, you realize if you put a big chunk of your money into one syndication, even if it's a big apartment complex, there's a fair amount of risk there. And so I think probably the lesson learned is diversification, number one. And number two, that people matter in an
Yeah.
investment like that. And
So
you want to
much.
make sure you're in with the right people.
Yeah, you're not alone. I mean, especially in the private world, we've all had those experiences. If you invest long enough, I've had a goose egg, but I think, even in your experience, and the reason there's a parallel because your bad investments actually brought you to maybe the white coat investor, not the one you're talking about. But if I look back at my history and the thing that really, even why my partner and I started Origin, it was very similar reasons. And, goose eggs you look at how other people treat your money, and nobody treats your money like you do at the same time. So I totally get it. You look back and I think when you're in the moment, you kind of feel dumb. You feel, that this should have been avoided, but it always leads to maybe something better in the long run, makes you a smarter investor. And we all appreciate you writing about it and, just being honest here. So I'm sure you'll write a blog in the future about what went wrong and we can all learn from it. And we don't have to make those same mistakes as well. So let me jump, Jim. We are 11:50 right now, so we're 5 minutes into the Q&A section, and I will. We had some that I really want to talk about really quickly. Here's a question that came in beforehand, so before I get to the live ones, but what role can we play to teach our kids to be financially responsible adults?
I think the most important thing is to model good behavior. They need to realize that just because you have money doesn't mean you have to show it off. I think that matters. Number two, just increasing their financial literacy. They need to know what debt is and what interest rates are and what a savings account is and what an investing account is. So for example, my kids have 4 accounts. They have a local savings account at the local credit union we walk them down to, and they make deposits, and they give them some money for their A's and B's, and they can learn some lessons there. But they have some bigger accounts. They have a 529 account for their college. And so I share those statements with them when they come in each month. This month, they learned that those accounts go down in value sometimes, and so that's a helpful lesson for them to learn while they're young. They've got Roth IRAs too for their earned money. Anything they earn, whether it's working for the neighbors or, one of my daughters is a lifeguard right now, that money goes into the Roth IRA, and I give them the daddy match. Basically I give them the same amount of money that they earned, and they can spend my money, and they put their money in the Roth IRA. And then I have a third account that I provided, a UTMA account, which is basically a taxable account for minors. That is what we call the Twenties Fund. And it's money they can use for anything they want in their 20s, cars, houses, weddings, honeymoons, missionary work, whatever. Because I just recognized back in my life that when I most needed money, but had the least capacity to get it, was my 20s. And so I've tried to, rather than give them some big fat inheritance when they're 60, I've tried to give them less money when they're 20. That'll make a bigger difference in their lives.
Good for you. And I think so many people with wealth, we all worry, that our wealth will somehow sap the work ethic of our children. And you see some people who do it so well, and we know wealthy families who have incredibly kids who just have this amazing work ethic, right? So I think that's always a fear from that wealth will somehow ruin your kids. But it sounds like the way you're doing it, your kids are still working, and it's a matching program, and they're thinking long term, and you're not just giving them the money for their own use. Is that accurate?
Yeah, I think that's fair. I think there's 5 activities you do with money. You got to earn it, save it, invest it, spend it, and give it. And every one of those takes significant effort. But so we try to walk them through each of those activities so they can learn all of them before they're adults.
Yeah. So Jim, let me ask you quickly. We had a lot of questions come in, and I think, this is an interesting time, but high income earners, they tend to also pay high taxes, right? So do you have a wealth building strategy around, and how do you consider taxes in a wealth building strategy as people are investing? And lastly, I'm going to couple this together because we had 5 or 6 questions come in. But as we look out at government debt out there, right? And I think we all know that taxes are going one place at the federal and state levels, they're going up. So how do you really look at that as part of your portfolio allocation and a wealth building strategy for people who are high income earners in a high tax environment?
Well, I think there's a couple of big things that can be done when you're a high earner that are really big, major tax deductions worth paying attention to. Number one is your tax deferred retirement accounts. Max them out. That's a huge savings, not only now up front, but usually you're able to pull that money out, even with higher brackets, at a lower rate because you fill the brackets as you take the money out in retirement. And so I think they're worth using. They provide asset protection benefits, estate planning benefits, et cetera. Use your retirement accounts. During your peak earnings years, those tax-deferred retirement accounts are good, despite the risk of tax rates actually going up in the future. Number 2, this 199A deduction for anybody that's self-employed is worth restructuring your whole financial life around. It is a massive deduction. And so if you can qualify for that, I think that is worth spending significant effort on understanding and getting in your life. If you can qualify for the 199A deduction, this is the pass-through business deduction that was passed starting in 2018. But as far as brackets going up in the future, they've basically been saying that for years and years and years and years, the rates must go up. And then of course, in 2018, they went down. So my crystal ball on rates is definitely cloudy. There is a lot of government debt out there. There are a few ways to deal with it. One, we may just carry around more debt for longer, but they could also pay it off by raising taxes or by increasing inflation. So it's entirely possible the tax rates don't go up formally, but the informal tax known as inflation goes up and basically just, wipes out some of your wealth that way. So I think you need to be protected against both of those, with some tax diversification, tax deferred and Roth accounts, as well as some money in taxable accounts, but also realize that you better protect yourself against inflation too, with assets like real estate and stocks and inflation protected securities.
Yeah. Great advice for everybody. I'm going to ask you a couple of questions. I'm going to take a live question now. Is it a good investment to move to a state with no income tax?
Well, sure. You just saved a whole bunch of money right there. That said, you got to weigh it with everything else in your financial life. A lot of people talk about this as geographic arbitrage. And my favorite example is always California. You leave California. If you're a doctor, you probably make more money after you leave. You have dramatically lower cost of living, and your tax bill just went down dramatically, going from California to Nevada or Texas. It's a massive boon to your finances. But that said, most people who live in California aren't living there for financial reasons. They're living there for some other reason, and you have to weigh it against family or politics or beach time or whatever it is that you ended up in California for the first reason in the first
Right.
place.
Sunshine State. Yeah, you pay that sunshine tax there. That's one of the challenges with Chicago with taxes going up is it's cold, and we're about to see high taxes here. Jim, there's a question here about your favorite book, and I want to expand that to be, maybe you can talk about influencers who you listen to, a book recommendation, and also blogs that you read and resources that you can give to our audience today.
Okay, the easiest book for anybody to get through is called If You Can. It's by neurologist and financial guru William Bernstein. It's like 16 pages long. If you can't get through that, you can't get through any financial book. So I would recommend you get that. It's free. If you Google If You Can PDF, there are free copies floating around on the internet, and Dr. Bernstein is fine with you using them. This is a book he plans to give away. So I think that's worth reading. I think it's also worth reading something about investor and personal finance behavior. And my favorite book on that topic is by Wall Street Journal, former Wall Street Journal columnist Jonathan Clements. It's called How to Think About Money. And I think it is a great overview of behavioral finance and worth reading by anybody. Another classic out there that I think is worthwhile, particularly for doctors, maybe doctors with a spending problem, is the classic Millionaire Next Door and its subsequent iterations. Maybe that one's not even the best one of the series. Maybe the Millionaire Mind is better. But the classic is the Millionaire Next Door. And just that helps you to realize that wealth is what you don't see. It's money you don't spend, Most people think they want to be millionaires, but what they really want is to have is to spend $1 million. And they don't realize that those two things are polar opposites. You have $1 million, you become a millionaire by not spending $1 million. So I'd recommend those 3 books.
Right. And then what about influencers, people who maybe you follow yourself besides books and bloggers? What are some resources out there?
Oh, I think there's a lot of great resources out there. I would recommend some forums. Not just because there's a guru there, and there are lots of gurus on forums, but because you can crowdsource a lot of information. And I think that sunlight is the best disinfectant. And in a forum with a lot of people looking at stuff, if it's a good forum, it will, point out the bad ideas pretty rapidly. And 2 of my favorites, one is the bogleheads.org forum. It's very focused on Vanguard index funds. And on the real estate side, a forum called Bigger Pockets. Where there's all kinds of people who invest in real estate in lots of different ways. And I think that's worth looking at as well if you have more of a real estate focus. But I think I'd probably send people to forums. You'd be surprised how many very smart people are out there and giving their opinions on things for free.
Thank you. Appreciate that. Those are all valuable resources for our audience here. I'm going to go into, somebody has a question here about inflation protected securities. What are your recommendations there?
So I hold 10% of my portfolio in inflation protected securities. I've done that since I started investing back in 2004. So far, it has been the wrong move. Inflation has been very low for the last 15 years. And what tips protect you from is unexpected inflation. So in the event that you have unexpected inflation, it goes from 2% to 6 or 8% all of a sudden. Your tips are going to perform very, very well quickly in that environment. They're also bonds, they're Treasury Bonds, and so they provide a safe harbor in typical bad times. And so I do hold them as part of my portfolio. About half of my bond portfolio is inflation indexed. So I like them as an asset class. I like the fact that they provide diversification in the portfolio, but I'm not going to pretend they've been awesome over the last 15 years. The risk they protect against hasn't shown up. So,
well, it's kind of funny too, because
in retrospect, it wasn't the right move, but that's you expect something to be going down if you have a diversified portfolio.
Right. Every dog has its day though. So don't change course now. With same, Jim, we talked about this a little bit, but your view on venture and private equity investments and why you only hold private real estate as part of your portfolio and now not venture and private equity. And I think you touched on this name, depreciation. Is that the only reason?
Well, that's one reason. The other reason is I actually have a large percentage of my net worth tied up in small private companies. probably 75 to 80% of my net worth is
Yeah.
tied up in the White Coat Investor and the White Coat Investor Network blogs. And so I am invested in small companies that I keep a very close eye on, that I have my fingers in, and I have, my finger on the pulse of, and that I know better than most other people in the world. And so I'm perfectly fine with you investing in that sort of stuff, but I think you need that approach. You got to be intimately connected with it. And I haven't found a great way to get in on the private side, in kind of a detached, passive way. It was something I'm not involved in. And so I've leaned away from it. But part of the issue too is there's thousands and thousands of investments out there. You don't have to invest in them all. All you need to do is figure out which ones you like and stick with those in the long term. You don't have to invest in everything. I can get the same question: why don't you invest in Bitcoin, or why don't you invest in precious metals or commodities or this or that? And the truth is, I don't need to reach my goals. You don't have to invest in everything. It's Warren Buffett's analogy, I think, that there are no called strikes in investing. You can just let them keep coming across the plate all day. And if you don't see one you like, just keep letting them go. And that's kind of the way I felt about private equity up until this point, at least.
Yeah, it's interesting. Well, you don't suffer from FOMO, right? Fear of missing out. As Bitcoin is going through 1,000%, I think people kind of change their portfolios. But this goes back to your point about having a written financial plan and sticking to it, and I guess amending it when you know that it's really at a point where it needs to be permanently amended, and doing that. And we do see some people now adopting cryptocurrencies and things like that as a part of their portfolio, maybe in lieu of gold and other things. So
yeah, I think if you're amending that plan more than about once a decade, you're probably chasing performance, though.
Yeah.
So you got to be pretty careful amending your plans. But certainly if you put 2% or 5% of your portfolio into anything, you're probably going to be fine.
Yeah.
If you want to dabble in something, go ahead and do it, but put it in your financial plan and follow it.
Yeah. So Jim, I'm pretty sure this question is for you, but it says, what percentage of your income do you personally invest across all investments, retirement, kids, college, et cetera? Do you stick to the 20%, or is it more?
It's more. It hasn't always been more. When I was in residency, it was probably 6%. In those few years right out of residency, I think it peaked at about 65% of gross income that was going toward investments. Right now, I'm paying about 35% of my gross income in taxes, though. So I can't invest 65% of my gross income. There wouldn't be anything to live on. But we're certainly investing 50% of our gross income now. But that's mostly just because the White Coat Investor has done so well, and frankly, we can afford to do so and give money back. And so that's kind of where we are right now. But basically, the bottom line is the more you save, the sooner you reach financial independence. 20% is adequate if you want to have a typical career. If you want to retire early, you might want to boost that number up a bit.
So last question we're going to take here. We're over on time a little bit before we wrap it up. But this one really hits on what we're talking about, which is turning a high income into high net worth. And this person says, for a 21-year-old living like a resident, paid student loans completely down. She doesn't have a large income, but she's saving money, and she's scared about investing and losing everything. What advice can I give her?
I think the best advice for a 21-year-old with a low income is to invest in yourself. Whatever that might be. It might be starting your own business. It might be getting a raise. It might be developing some new skills so you're more attractive to your next employer. It might be going to medical school. It's investing in yourself and getting that income up. It is so much easier to become wealthy when you make $250,000 a year than when you make $50,000 a year. And so rather than focusing so much on the retirement accounts or the investments, I would focus on you. When you're 21, figure out a way to double your income. It's easier than you think it is going to be. I can promise you that.
Yeah, that's good advice. I suppose, one of the things that I read into that was they're just scared to risk money that they're saving, right? And I understand that. Is that maybe just an educational piece that they have to educate themselves more on the markets and how they work? Because what I read there is they're afraid of losing everything. And so if you're in the S&P, for the S&P to go to zero, that just really theoretically, I suppose it could happen, but we'd have much worse problems. So I don't think you can put your money anywhere there. But I think we've seen the major drawdowns. That's kind of how I read it a little bit. Is there's some people just who don't like volatility in their life.
Yeah, I mean, I think you can certainly invest in investments that are less volatile,
Yeah.
but basically you got two choices. One, they're less volatile because they're just not marked to market every day,
Yeah.
and you just don't see the volatility. It's really there. You're just not seeing it, and that's kind of typically the case with private real estate, for instance.
Right.
Or two, you invest in something with a low return.
Mm-hmm.
And the problem is you need your money to do a significant portion of the heavy lifting to build the nest egg you need to live off of after you retire. And
Right.
so it's when you're 21, especially, I mean, that's the time to be taking risk with your investments of your long-term money. This is not money you need next month to make rent. It's not even your emergency fund. It's not even money you might need in the next couple of years, but money that you don't need for 30 years. What do you care what it does this month, right? Focus on the long term and stick with the plan through the ups and downs, and you'll be surprised how much money you have at 31 and 41 and 51.
Yeah. Very simple financial advice. I mean, we said that in the beginning. The stuff that you're talking about is not complex. It's just repetitive. Boom. Just keep hammering it in and do it. And I find it interesting that 1/3 of your readers have a financial plan, even though you constantly hammer that home. So hopefully we can get more people to do that. And with what you just said, I mean, is it realistic for people in their 20s and 30s to become, who are mid-wage earners? Maybe they're not doctors, but contributing to their 401k plan to be financially independent, retire early, part of the FIRE movement?
Absolutely. Absolutely. I think it's entirely possible, especially when you start that early. I mean, bear in mind that most doctors and similar professionals don't even start saving until their 30s and might not have their student loans paid off until 5 or 10 years later. And that's if they're doing a good job of it. So you're 20 years ahead of those folks. That's a lot of time for compound interest to work.
Yeah.
And although there's probably a few exceptions out there, I think the vast majority of Americans have the capacity to retire as millionaires just from a steady, solid saving and investing program.
Yeah, they have the potential. And that's really, one of the reasons why we wanted to invite you on is just to hear that message over and over and over, because people have the potential, but so many people who, if you're in your 20s and 30s, you got to do something. You have to start saving today. You can't say that, can't happen. I'll do it tomorrow. I'll do this. And, the more you do it, the better off you're going to be in the long run. And you can defer a little bit of your income, into your savings and your investments. You'll be much better off in the end. So that's all we have today, Jim. Thank you so much for your time. We really appreciate it. I do want to remind everybody, Jim was being humble. He mentioned a couple books. I would recommend his books. His books, even though they're written for doctors, they are practical. They give great advice. You can buy those. You will find nuggets of information that will save you a lot more than that. Subscribe to his blog. It's free. It's great. Ends up in your inbox every morning. Lots of good stuff along the way. So, Jim, any last minute thoughts or questions for me before we cut this off?
I think it's just important for investors to remember who their biggest enemy is. And it's that guy staring back at them in the mirror every morning. If you can overcome your own tendencies to spend too much or flake out on your investments, I think that's going to take you a long way.
All right. Well, thank you for those parting thoughts. And we appreciate everybody being here. Big thank you to Jim for spending an hour with us and sharing your wisdom. Great hour here. So again, everybody be safe, and we thank you for participating in this webinar today.
Thank you.